Why would marking gold to market raise the price of physical gold enormously and then lead to huge amounts of food price inflation, which is really the most important part of the Keynesian definition of inflation, because when basic necessities become unaffordable, people start to riot. There are several ways to think of it. The simplest one is this, that gold at the Fed on its balance sheet is not convertible. You cannot go to the Fed with your dollars and get the gold that it has in its basement. What you can do is you can buy gold at a coin shop. So right now, the premium for gold at $3,400 is the gold that you can actually hold in your hand. You can go to a coin shop for $3,400, give them the cash, and they will give you an ounce of gold.
In today's news recap, silver holds strong momentum. Silver prices were at $37.7 per ounce today, extending the strong momentum since the start of the year amid signs of robust industrial demand and the outlook of rate cuts by the Federal Reserve. China installed over 93 gigawatts capacity of solar panels in May, a 300% surge annually to a fresh record high before a new set of policy changes would make it more difficult to attach panels to grids. Additionally, the State Grid Corporation of China stated it would exceed $90 billion in grid investments this year to prevent curtailment of solar power, set to ease concerns of future demand for photovoltaic panels, which are silver's main industrial use. In the meantime, the lack of aggressive upsides in the latest CPI report drove markets to pile on bets of a rate cut by the Fed in September. This, combined with the impact of pessimistic ISM PMI results and the downward revision in non-farm payrolls supporting bullion assets without yield. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
Now that, let's go to the charts and an explanation why a gold revaluation would lead to a quick dollar devaluation from an Austrian school positivist logical perspective. For our first chart today, people have been asking me how long is this consolidation in gold going to last, and silver as well. Well, we're at nearly 4 months now, or a little bit past 4 months, about 4 months. We can see here that the candles are the price of the gold miners as represented by the GDX and GDXJ ETFs. We can see here they are both headed higher as of the beginning of August relative to gold, which remains in consolidation. The miners have broken out. When the miners tend to lead gold, that means that gold usually is at the end of its consolidation. Miners usually lead gold in their move. If miners are headed down and gold is not yet, that usually means that gold is headed for a dip. If miners are headed up and gold is not yet, that usually means that miners are leading gold higher. This consolidation is about to end. In my humble estimation, that is. You can see here that miners are up about 25% for the month of August, and gold has been relatively static. Where are we in terms of how nervous the Treasury is getting before there is something bad that happens in the monetary system? Well, it looks like Scott Bessent, our favorite Treasury Secretary, is getting pretty desperate because he's begging the Fed to cut rates 150 basis points from Bloomberg. U.S. Treasury Secretary Scott Bessent made his most explicit call yet for the Federal Reserve to execute a cycle of interest rate cuts, suggesting the central bank's benchmark ought to be at least 1.5 percentage points, that is 150 basis points, lower than it is now. I think we could go into a series of rate cuts here, starting with a 50 basis point cut in September. That's what he wants. Bessent said in a television interview on Wednesday, if you look at any model, whoa, those models got to be hot. Yes, that we should probably be 150, 175 basis points lower. I wonder what model he's looking at. I can make an inappropriate joke here, but I won't. One thing I noticed on Gold Charts R Us. This is a great site that I have a subscription to, and I recommend if you really follow the gold markets, it is very helpful. I looked at the gold future spread because I noticed that there was a record low spread between the 2-month and spot rate, which we'll get to in the next chart. But I noticed that anytime the spreads start to widen between maturities, between expirations, you have what is eventually or very soon after a financial crisis. This is what happened in 2008. We can see the spreads widening out here between the expirations. You can see all the colors up here. I can't see them that well, but I can see that they're spread out during the 2008 or just before the 2008 financial crisis, and then they tightened up again over here. They spread out a lot in 2018, 2019, right before the September 2019 repocalypse, when repo rates went to 10% and the Fed had to restart QE. They have spread out for a long time, since the beginning of 2023 over here, and they remain at near record spreads, excluding the lockdown over here. But we have what is a record negative spread between the 2-month and the spot price, which is the lease rate spread, how much it costs to lease gold for 2 months. It costs here 3.18%, which is an all-time record high. This was about 2 days ago. And so this is one indicator of gold backwardation. I don't think it's going to stick yet, but if gold is flirting with backwardation because gold now is worth more than gold in the future, which is a backward-dated state. And another word for endgame is permanent gold backwardation.
In today's news recap, Citi raises gold forecast to $3,500 per ounce over the next 3 months on negative U.S. outlook. Citi raised its gold price forecast over next 3 months to $3,500 per ounce on Monday from $3,300, and the expected trading range to $3,300 to $3,600 from $3,100 to $3,500 on the belief that near-term U.S. growth and inflation outlook has deteriorated. U.S. growth and tariff-related inflation concerns are set to remain elevated during the second half of 2025, which, alongside a weaker dollar, are set to drive gold moderately higher to new all-time highs, the bank said. Last week, U.S. President Donald Trump imposed steep tariffs on exports from dozens of trading partners, including Canada, Brazil, India, and Taiwan. The tariffs imposed last week on scores of countries are likely to stay in place rather than be cut as part of continuing negotiations. Trade Representative Jamieson Greer said on CBS show Face the Nation, aired on Sunday. Last week, the dollar weakened after non-farm payrolls increasing by 73,000 jobs last month, after rising by a downwardly revised 14,000 in June, which revived hopes of a Fed rate cut in September, with markets now pricing in an 81% chance. Per CME FedWatch tool Citi also highlights weaker U.S. labor data in second quarter of 2025. Institutional credibility concerns have increased regarding the Federal Reserve and U.S. statistics and elevated geopolitical risks related to the Russia-Ukraine conflict. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
To me by Craig Hemke, who we will quote in the next slide. August 1st, 2025, official reserve revaluations, the international experience. Whoa, that sounds really sexy. This is by Colin Weiss, who you can see at the bottom here, his education. He has a PhD in economics from the UCLA in 2017 and a degree in BS economics from University of Pittsburgh in 2012. He says, with public debt at high levels, some governments have begun to explore financing additional expenditures without raising taxes while also not increasing public debt outstanding. One possibility is using proceeds from valuation gains on gold reserves, as has been floated in the U.S. and Belgium recently. For the U.S., this would involve revaluing the government's 261.5 million troy ounces in gold reserves, the largest gold reserves globally, from a statutory price of $42.22 per troy ounce to current market prices, which stand around $3,300 per troy ounce. Now it's $3,400. So What would that mean? If you read this article, which I'll put in the link in the description below, it's full of a bunch of crap, which talks about some insignificant gold revaluations in the past few decades, but totally ignores the big one in 1933, 1934 of $21 to $35 a troy ounce, and then the big one in 1971 from $35 per troy ounce or $42 per troy ounce to whatever the market says, which was a gold default. What happened to prices in both of these circumstances? We're going to look at food prices in the immediate aftermath of these revaluations. You'll see it's not good. Here's what Craig Hemke says on the situation. I will link his article in the description below. In the end, Craig says, connecting all the dots for this picture is about as simple as a children's workbook. The politicians are warning you that an official gold evaluation is coming, and the price action since Trump was elected is telling the same story. The only question, what becomes of the market price for gold when this official revaluation happens? And he says, no one knows. Seriously. Well, I do. I just don't know exactly how long it's going to take from the official revaluation to endgame. I don't even know if we're going to make it as far as an official revaluation before the market forces it. But anyway, I'm going to finish his paragraph and then explain why I believe this is so. How could anyone be certain, as no one alive today has lived through the unofficial U.S. government evaluation? Well, I would say that we can still look at the data of an official U.S. government evaluation, and some people who are alive today have lived through it, those who were born in the 1920s and they're centenarians, and they were teenagers when it happened in 1933. Some of them are still alive, and we can find some of them. Anyway, if the U.S. just simply uses the London PM fix of, say, June 15th, 2026, and does that mean, what does that mean for the gold price on June 16th? Probably nothing. However, it speaks volumes regarding the value of gold as something other than a barbarous relic. Additionally, other central banks and governments around the world may follow suit and issue their own official revaluations. Absolutely. If the U.S. government revalues its gold, of course, the other governments of the world will revalue theirs. And usually we're talking about the central banks here and not the government. But why do I think that the price of gold will head up higher very fast when there is an official gold revaluation mark to market? Well, here is some of the evidence, and then I'll give a logical explanation. First of all, the gold revaluations and inflation below was a 66% revaluation. This one would be 60 times larger than that because we'd be revaluing gold from $42.22 to about $3,400, which is 60 times larger than the 66% revaluation of 1933. So here you can see these are food prices. I'm going into food prices because I want to know how a gold revaluation was followed. I'm not necessarily going to say affected by directly, but was followed by a huge spurt in food price inflation increases, which means that basic necessities got extremely expensive once the revaluation happened shortly after. You can see here that April 1933, food prices were going down 15.3%. By March 1934, less than 1 year later, food prices were rising at an annual clip of 22.3%. This was only on a 66% revaluation of gold, meaning devaluation of the dollar. Here is the August 1971 gold default. We call it a revaluation, dollar devaluation. It's all the same thing. The August 1971 gold default went from a 3.5% rate in food price inflation in August 1971 to 20%, 19.8% by August 1973. Just about 2 years later, we had the major stagflation of the 1970s, and the only way it was brought down was by the Treasury selling its gold reserves off to try to suppress the price of gold. And now
What do you think of Rafi's take? Do you agree that silver is still massively undervalued and that a return to the 1980 Dow to silver ratio could drive it toward $2,400 an ounce? Or do you think this big reset scenario is overblown? Is it a coming reality? Or just wishful thinking and market hype? Post your honest opinion in the comments below and share your own gold and silver price predictions with the stacker community. Now, check out this next video right here. It's the perfect follow-up for you. I'll see you on the other side.